Hey guys, here Jason Sharon, Home Loans Inc. here to talk to you about inflation, how it's measured, where it's going, and how does it cause a recession. So inflation, going to the definition from Webster, is a continuing rise in a general price level, usually attributed to an increase in the volume of money and credit relative to available goods and services. So what causes inflation? So it goes back to your Econ 101 class. So we look at this, we have a demand line and we have a supply line. So you see here with this particular supply demand algorithm, prices are based on they're going to be this dollar amount. And then as your demand increases, you push up this line, you have a new demand line, same supply line. So let's say the supply has not changed whatsoever. Now with more demand, your price is higher. Super simple, easy. So you just think about what causes inflation, supply and demand. There's more demand than there is supply. So let's go to the CPI, Consumer Price Index. This is a monthly number gets released by the Bureau of Labor Statistics that represents 200 categories encompassing all goods and services purchased for consumption by Americans. And there are 8 major groups: food and bev, textiles, medical, energy, housing, education, communication, all that stuff. So that's what the CPI is. So I wanted to kind of define a few things so we get to some higher level discussions. What's a recession? It's a 2 consecutive quarters of negative economic growth measured by the country's GDP change. Super simple, is the economy producing less, spending less this quarter than last quarter. And if that happened 2 quarters in a row, it's a recession. Maybe a very small recession, but by definition, that's the recession. How is inflation measured? So another basic that I want to cover, it's really an adding up the last 12 months of the CPI. So for the year of 2022, you would have the January CPI plus February plus March. You get it all the way up to December, and that's going to be your yearly inflationary number. So let's go on. So how do we apply that? So where's today's inflation number come from? So you look at the last 12 months. So July of 2021 was 0.5%, August was 0.3%, September of 2020 was 0.4%, so on and so forth, all the way up to June. Last month's CPI was 1.3%. Add all those numbers up, and you get inflation of 8.6%. So that's where inflation comes. That's what inflation is, where it comes from, and what today's numbers are. So let's go on to the next. Where's inflation going to go? So let's talk about 2 things. So if we had no more inflation, so let's say everything stayed the exact same price between now and December 31st. So as each month progresses, you replace that 12 months ago number with a 0. So we would replace July or September through December with 0. The January inflation numbers will be 5.2%, which is still super high, and it's way above the Federal Reserve's target of about 2%. So let's say idea 2 to talk about is, let's say CPI for July is 0.8%. Well, the July of last year was 0.5, so we replace this 0.5 with new 0.8, and inflation would show an increase of 0.3%. So 0.8 minus 0.5 is 0.3. So hopefully that makes sense, that you take the 12-month ago number, replace it with this month's number, and that's how you adjust inflation month to month. So if that's the case, I'm not saying it is, but if that's the case, if July is 0.8, our new number is going to be 8.9. So since the July through September CPI numbers were low, and I'll show you that in a second, I predict inflation is going to increase until at least October or November. And I'll show you what I mean by that. So here is a graphical representation of the CPI over the last several years. So if you look at here in June 1.3, come back to June of 0.9. So this last time we replaced this 0.9 number with this 1.3 number. So next month we're going to replace 0.5 with a new number, then a 0.3 and a 0.4. So these numbers are very low relative. So if we get another 1 or 1.5, we're going to see inflation numbers in the 10s, maybe 11 or 12 over the next several months. Once we get up here to October, November, we're replacing a 0.9 and a 0.7. If the CPI for the month is lower than that, we'll see inflation come down. But my gut tells me we're not going to see anything really till maybe we're replacing February and March numbers if the Fed gets inflation, the monthly CPI numbers under control. So how does inflation lead into recession? Well, as the price as inflation happens, goods and services cost more, and wages just don't increase. So therefore, there's less demand. Remember the supply and demand curve. We're going to come back to that in a moment. So we just don't have the increased money to spend. So what happens is Americans start using their credit cards, right? They start borrowing HELOCs, credit cards, whatever it is. And since interest rates are so low right now, that's a very attractive behavior for consumers to have. So eventually you run out of money to buy, run out of money to borrow, and it catches up again and you just can't get any more. And that point, whenever Americans just can't spend more, then you start seeing that recessionary activity. So, how should the Fed's action of raising rates reduce inflation? So, you saw this graph earlier, you're a little bit familiar with it. So, let's say now we've got this point here. So, we've got our supply and we've got our demand. And now, let's say you just don't have enough money. You can't borrow more money to buy more stuff. So, the demand is going to slide down. So, this demand line will shift to the left or downwards, however you want to call it. And now the price of goods will come from this P prime down to P. So just simple, there's no more money to spend. There's less dollars chasing product. The price is going to come down because people are still going to need to sell their goods or service to live. Now, I didn't want to get a too complex of a graph here. If you go take a look at what's going on today, not only do we have this demand curve shifting, we also have the supply curve shifting, right? With all the issues with the supply chain and not be able to get stuff. Remember toilet paper, remember all the stuff with that boat trapped in the Suez, all the different things that you just can't get anymore. So the supply curve is going to shift to where now there's less supplies, but for the same demand, it's going to cause prices to go up. It's just simple economics 101. So let's talk about patterns. So this is about 30 to 40 years of history in this one graph. So we've got Fed Chair, Burns, Volcker, Greenspan, and then good old Jerome Powell right now, and looking at what happened these two instances and then here. So during their tenure, inflation went from 7 up to 14%. Mortgage rates climbed from 12 up to 18%. Just facts. They took action to raise the Fed funds rate. It was 11. They raised up to 20%, right? We're at 2 point something right now, like 2.25 approximately. From this action here, inflation dropped from 14 down to 5. 5% is still high, but that's a lot better than 14%, right? Mortgage rates in response to that dropped from 18 down to 12%. S&P was down 30%, and we're in a recession. So let's come over to under Greenspan's tenure. Inflation went from 1.75 to 3.5. Rates went from 7 up to 8.5. He raised the Fed funds rate only about 2%. That dropped inflation from 3.5 down to 1. Dropped mortgage rates by 3%. S&P dropped 50% under that time frame and put us in a recession. So let's look at Jerome Powell here. Inflation went from 1.5. This slide is about a month and a half, 2 months old. So now we're up almost 9% is what inflation's done. Mortgage rates have gone from 2.5 up to about 5.5 in today's market. Fed funds rate is now over 2. It's like 2.125, 2.25. With more changes next month, the 0.75% next month in September should take us into the 3% range. So at the point we'll go from 0 to 3. Inflation should drop eventually, as we see what's probably not going to drop in the next 90 days, maybe not the next 180 days. And then mortgage rates will decline after that. Stock market is coming down. Stocks are expensive, were expensive when this slide was written, but they've come down significantly. We're in a bear market on a lot of things. And the economy is slowing, which is good. So we're going to be in a recession. It's just not a matter of if, it's when. So the question I get a lot is, how does this affect my buying behavior? What should I be doing? Should I be buying houses? Me, yes, I'm buying houses. My goal is to buy 4 more houses over the next 12 months, some here, some internationally, but my goal is to do that. And here's why. So every recession has resulted in higher housing prices. You see the vertical bar, great dark bars are recessions, and then the Case-Shiller housing price index is represented by this white number. So you see coming in all the way back to the 50s. In the 70s recession, in the 80s recession, the dot-com bubble. You've got here's the housing bubble. So yes, it did come down here, but I would say that it's not that the recession caused prices to go up. The housing bubble caused the recession. So this is an abnormality compared to here because of the cause. The root cause was different in this recession than the other recessions. You see our COVID recession, what happened with housing prices and what's going on after that. It's still, houses are going to be are a safe investment. Are they going to go up as fast? No, but you're still gonna be fine. You're still gonna have that safe security. It's a whole lot better than the insecurity of renting. So special thanks to Barry over at MBS Highway. I listen to him, I follow him, I study him. Most of these graphs I stole from him with slight modifications. He's just a great guy to follow and understand and study. If you got questions about me, here's how to get a hold of me, the states I'm licensed, and that kind of stuff. Hopefully it was helpful. You got any questions, reach out to me. Take care. Bye.